Our reaction during the crisis was one of contrarian investing. Mm-hmm. We bought a lot of stocks around the bottom. Mm-hmm. I can't say we timed the bottom directly, but we bought some before, some during, some after, about 16 billions worth of stock exposure. Mm-hmm. We bought because we thought that central banks and fiscal authorities would come to the rescue. Mm-hmm. And ultimately, valuations became very attractive. It was a difficult period. It was a stressful period for investing. But in hindsight, we're glad we acted as contrarians. The COVID crisis also changed our investment process because now we have to deal with what I would call COVID distortions. Economic data that's very hard to read. Massive outliers in the data that we've never seen before, whether it's in terms of unemployment distortions, supply chain distortions, or generally speaking, liquidity-driven distortions in markets. Now we're in an environment where we're finally starting to unwind COVID distortions. But COVID is still a factor for investing in markets, especially in China, but also in terms of supply chains. So broadly speaking, that would be my answer. We reacted by buying risk assets around the sell-offs because we saw opportunities to buy stocks when they were cheap, to lean against the wind. But we also revisited how we think about tactical asset allocation to account for the COVID factor. Over 12 months following, and at some point over the next year and a half, we then progressively took profit and went back to neutral. Now, this year, in 2022, entering the year, we were underweight stocks relative to bonds. So we like to talk as an industry of the 60-40 portfolio. That's often a reference portfolio. Of course, 60-40 means 60% stocks, 40% bonds. It represents a risk profile that can fit many investors. If we look at our stock bond mix this year, using a 60-40 example, we've been quite close to the 60-40. In fact, we're at about 57-58 of the 60. So it has not been a massive de-risking of the portfolio. Broadly, though, I also think that we need to modernize those 60-40 types of portfolios. I think that we're going through a regime shift in markets from declining rates to rising rates, from low inflation risk to higher inflation risk, from very defensive central banks and fiscal authorities that always come to the rescue, to central banks that actually need to fight inflation for real. Maybe not in Japan as much, but definitely in Europe and in the US. And this regime shift means that we need to rethink those types of portfolios. In models, for example, we would shift as much as 10 to 15% of the 40% in bonds to alternative investments. So in alternative investments, we typically try to achieve an absolute return objective that's not correlated with stocks or correlated with bonds. So in our case, most of our investors require liquidity. So we're talking about liquid alternatives, hedge fund strategies. We manage hedge fund strategies. Also, generally speaking, when we look at liquid alternatives, we look at all markets, all liquid markets. But generally strategies that use dynamic duration, for example, dynamic fixed income exposures, relative value exposures between currency markets or between equity markets, or investors who are willing to give up some liquidity. it makes a lot of sense to invest a portion of the portfolio in private markets. Private markets are not a panacea. They're not the solution to every asset allocation problems, but they have a role to play for investors who are looking to earn a premium for giving up some liquidity in the portfolio. And they can have, in times of crises, if not carefully selected, high correlations with equities. Alternatives can go down at the same time as equities. So the structure of that portion of the portfolio needs to be carefully considered to focus on an absolute return objective. The selection of the managers running the alternative strategies really matters. I'm also not saying that we should get rid of all government bonds in our portfolios because they don't work anymore as hedges. I am not saying that, but I'm saying that generally speaking, because of the regime shift, we need to re-optimize the 60-40 with a relatively smaller role for government bonds or investment-grade bonds and a relatively bigger role for alternatives, risk-managed equities, in an environment where interest rates may be rising, inflation may be volatile, and we might face less of a central bank protection.
Yeah.
The loss, we call it the Fed put for those familiar with derivatives. The Fed put means that the Federal Reserve in the US tends to come to the rescue when markets crash. Well, in the current environment, that's more difficult. So we need to rethink portfolio construction accordingly. Ultimately, if the Fed put is gone, it means that the reward for taking equity risk should go up. And theoretically, the valuation of equities should go down. However, I don't think that means that we should sell all of our equities and go to cash, because for long-term investment perspectives, equities are the engine of growth in portfolios. And if I don't know anything about you and you meet me and you ask me in 10 seconds to tell you how I think about investing, I will say two things. Stay invested and stay diversified for the long run. Over time, stocks tend to do well when we have inflation. Better than nominal bonds. I think in the US, it has probably peaked, but I also think that it will be very difficult for the Fed to bring inflation down to 2% anytime soon. I think we could continue to run at 4-5% year-over-year headline inflation for the next year and a half, and that will create pressure in many parts of the capital markets. Inflation is going to be stickier because of general scarcity in commodities, even though commodities prices are coming down fast because of sustained supply-demand imbalance, although it's going to work its way through, but also in the US because rental inflation is going to persist for the next 12 to 16 months, almost by definition. Because a lot of people, in the way the data is calculated, have not renewed their lease yet. And so if you have a lease that you signed 2 years ago, your rent might be fairly low. But if you're about to renew your lease, your rent is going to jump up. And that is going to work its way through the inflation numbers. Housing in the US inflation numbers is as much as 30%. So that creates a sticky component to inflation. That's a big component of my view of why it's going to be sticky. So, to summarize my views on inflation, I think it has peaked with base effect and supply chains getting better and some of the COVID distortions working their way through in terms of hotels, airlines, all these numbers are down, gasoline prices are down. But because of services and housing and just general supply-demand issues in commodities markets, geopolitical risk, it's going to be sticky for a while. And you know what? That remains a big risk for markets. I think it's hard to argue that the Fed has been too aggressive. There is really a need to bring inflation under control. It's a little bit different here in Japan because you're still printing fairly low numbers. But globally, you've seen 10% plus in the UK. Europe is struggling with inflation caused by energy in particular, but other factors. And that really becomes a political issue. It becomes an issue for consumers who have to buy gasoline to drive their cars, to buy food. And those are expenses that are very difficult to bring down. And then there's less money left over to spend. And consumer is a big part of the economic growth in the US and globally. Increasing rates put pressure on investments. And so it's not an easy task nowadays to be a central banker. We always have risks of, and I hate to even think about this, but we have to recognize that it is a tail risk, small probability, very large consequences. Yet another more devastating pandemic. I think the biggest tail risks over the next 2 to 3 years are clearly a severe global recession caused by yet another commodities shock. I think commodities are the source of risk in economies and financial markets, even though they're trending down at the moment. Russia and Ukraine represent about 40% of the world's exports for wheat, but also for seed oil and other food commodities. It's been a major driver of food inflation. And I think that we were talking earlier about sticky inflation. I don't think we're out of this phase of accelerating food inflation. It's also clearly had a major impact on energy markets. So when you think back to what we were discussing earlier, the impact of Russia's invasion of Ukraine on commodities markets and ultimately on financial markets and on inflation cannot be underestimated. It was really a shock. I think of it through an analogy. If you go and drive your car today, you don't know if you're going to get in an accident. But it's a tail risk that you get in an accident. And what do you do in terms of the car analogy? Well, you have airbags, for example. You have safety features that will protect you in case of an accident whenever they will happen. So in portfolio construction, we need to have airbags. For many years in our portfolios, we had real asset equities, a diversified portfolio of REITs, real estate investment trusts, metals and mining companies, energy companies, precious metals companies. And that portion of our portfolio was underperforming, but it was our airbag for inflation. And we were in a regime where we didn't see an inflation, but in our mind there was always a tail risk that at some point you could get a significant inflation shock. So in terms of portfolio construction, you don't want to give up all your returns and go to cash because you might face a tail risk. But you do want to build resilience in the portfolio. There's also, I do believe in dynamic approach to portfolio management and risk management as well. There are environments where risks are elevated, where you can scale back on risk taking. So it's a combination of structural resilience and dynamic approaches. And both together can help you navigate tail risks in a way that doesn't take you completely out of markets because you want to be invested and you want to compound your return. I think it's important to account for your time horizon when you invest. And if your time horizon is fairly long, if you're going to retire in 5 years, 10 years, 15 years. And even if you're close to retirement, if you're going to need your savings for the rest of your life, I think it's important for Japanese investors to realize that to grow wealth over time, it's appropriate to take a fair amount of risk. I think it's very intuitive to not take enough equity risk and to just hold cash for savings. But if your time horizon is long enough, it's important to generate a compound rate of interest, allow the ups and downs in markets along the way, and really stay invested when there are ups and downs, and over time it tends to work out. That's why I think the concept of diversification always applies in markets, but applies particularly well to this current uncertain environment. It's like fortune cookie. You know, if you have a fortune cookie, you have a little ribbon that gives you advice or some life projection. If I were to put investment knowledge into a fortune cookie, right? You can't write much. I would write, stay invested, stay diversified.